let's talk about equity. As we're closing out the year, what kind of equity bets are you seeing investors make at Invesco? You run the 5th largest ETF in the world, the triple Qs, right. The NASDAQ 100. That's had new high, strong inflows, but you also run the equal weight S&P, right. Sort of the opposite bet of the RSP, which has also come off a high but had great inflows. Right. So characterize what's going on here.
Just speaking to QQQ, QQM, 40 billion in flows for us for the year, so about 4% of all market flows in ETFs, shows you the power of the performance that the innovation factor that we like to highlight has demonstrated, but it's also the concentration trade around the Magnificent Seven, of course. And you've seen that start to ebb and flow this year. 24 was really a tale of two markets. The first part of the market, very much a concentration story, and as we dovetailed into fears of inflation, rates decreasing, you started to see the market broaden out a bit, and that's really where the RSP S&P equal weight strategy takes that other view of concentration and helps investors balance out all of their portfolio risk. But to me, it really shows that you have this precision that investors are using ETFs for to really balance out either under concentration or over concentration within their portfolios.
Nate, riff on that for a minute. It seems like some investors want concentration and some investors want diversification. They seem to be asking for both at the same time.
Well, it's interesting because two of the ETFs that were just mentioned there in QQQ and RSP, those are both in the top 10 of ETF inflows overall this year. And then if you look just outside of the top 10, you have QQQM, which is the lower cost version of the triple Qs. So the way that I view this is that this has really become a major battle line in the markets right now, because there's one camp of investors who believe the market has grown too top heavy. And they believe valuations of the Mag 7 stocks and other mega cap names are overextended. And then there's another camp that says, well, look, that's what's been working. And so there's no reason to fight the tape here. And that latter camp has mostly been right for a long time now. But I think investors are growing a bit warier as to whether or not that can continue. What I think is really interesting from an ETF perspective is that we're seeing a number of new products come to market that allow investors to express their views on this concentration in a much more targeted fashion. So Invesco actually just launched the top triple Q ETF, QBIG, which captures the top 45% of the NASDAQ 100. We've seen other issuers launch products either targeting the largest mega cap names or specifically avoiding them. And what that tells you is issuers are clearly aware of this battle in the markets right now. I think we're going to continue to see sort of this tug of war play out moving forward.
Well, here's your chance to talk about QBIG. You're essentially, Nate's right, you're getting deeper into the concentration game. So you launched, this is just last week, right?
That's right.
QBIG, what we're talking about, folks. This captures the top 45% of companies in the NASDAQ 100 index. And again, concentrated bets still in a way.
That's right. Yeah, the Invesco top QQQ ETF, so really looking to capture 45% of the market cap of the NASDAQ 100. So as we know, the acronyms of Mag 7 and FANG have evolved, FANG with 2 A's over time. So this will allow you to really capture that concentration story within the index over time. And that's what investors were asking us for. Yeah. How do I dial up that exposure and really capture the majority of the drivers of returns in the NASDAQ?
You know, Nate, I'm torn about this. There's clearly some debate in the markets right now about whether it's time to diversify away from the Mag 7, for example, but other people don't think so. Other people are into either diversifying or just staying concentrated. This is a hard one to call right now. The Jack Bogle inside me says, be very careful about concentration, Bob. That doesn't work on the long period, over long periods of time, but maybe we're seeing some unusual development here where small groups of stocks are going to capture huge amounts of market share for much longer than is historically normal.
Yeah, my high level view on this, which I've talked about before, is that if you have been invested in market cap weighted indices, market cap weighted index ETFs, you have received the benefit of this growing concentration over the past 5 to 10 years. That has been a good thing. But as we sit here today, are there more risks involved in investing in those indices? Yes, I think you would have to say that concentration does present some additional risk. And so from my standpoint, I think that means it's time to diversify a little bit. Does that mean shed your market cap weighted exposure altogether? No, because again, that's worked. We know historically that works over the long run. But is there some additional risk as we sit here today? Yeah, and I think investors should be cognizant of that.
Not surprisingly, we're also seeing some factor rotations, but it's the typical suspects in an up market. So for example, it's momentum and quality. So you have a quality ETF, does very well, SPHQ. That's seen nice inflows as well. But when you look at what it is, it's really a big cap tech ownership still. SPHQ has Broadcom, Apple, Adobe, Cisco, Qualcomm. And you know how these work, folks. Quality is general profitability. Return on equity, I guess, is what you're looking for. And then you have, debt to book value, financial leverage or low financial leverage. Here's what SPHQ owns. These are the largest holdings in here. I don't have any problem with this. Quality is certainly a good way to go. It makes sense in terms of picking a factor. Anything you can. Well, I guess the question is, how long would quality necessarily work?
Yeah, I think quality is a testament of profitability and some of that concentration we've seen on earnings growth in the market. I think the bigger component we've seen with the rotations is the concept about market breadth, right? So market breadth allows for more market rotations, factor timing, and to the original question, where are we seeing some of those bets? We've actually seen a big shift from quality in that first half of the year move into momentum towards the second half of the year. And that is a testament of, again, the factor timing, the factor shift. There's a stat, I think the first half of the year, less than 25% of the S&P 500 companies actually outperformed the S&P 500. Second half of the year, it's well over half. So it's showing you there's more opportunity set within the market to be selecting from, and that factor leadership is starting to change, and we've definitely seen that.
A lot of quality is momentum right now, and not all quality is momentum necessarily, but a lot of quality right now is momentum. I keep waiting for some momentum to be, low volatility.
To be value, right.
when is value going to sort of make a comeback? But it doesn't happen here. I want to move on here. We've got a couple more subjects I want to hit on. I want to talk about fixed income a little bit. Bank loans, BKLN is private bank loans essentially, and tell us about how that's doing. It seems like it's had some inflows recently as well. Under what circumstances would something like bank loans do well?
Right, yeah, so bank loan is the 100 largest, most liquid senior loans. They typically have a floating rate tied to them, but we see the flows tend to ebb and flow depending on the market. So this year we actually saw more of the inflows into BKLN in the second half of the year, and I think that was when there was a little bit more certainty on the shape of the curve, where rates were going, and it was a bit of a credit and yield opportunity where investors were looking and favorable for taking some of the credit differentiation and getting the yield difference.
Now, you think this would be a play on interest rate changes, but really it's a play on credit, right? I mean, essentially you're going to be, if credit remains doing well, this will do well, right? I mean, what are we buying here? It's a play on credit, right?
Right. You tend to be a little bit less interest rate sensitive. BKLN was one of the first ETFs to access liquid loans, and we often see investors using it for part of their private credit sleeve, right?
Really?
From a liquidity standpoint. So as they're moving towards funding or as they're looking to dial up exposure, but potentially deals aren't available, they use that as a bit of a liquidity vehicle as a proxy towards some of their private credit, which has certainly been a topic.
Nate, what about that? He brought up private credit here, private equity, a hot subject right now. Could something like this, these bank loans, actually be considered a form of private credit? It's sort of like a magic pixie dust saying private credit these days.
I think you could probably mount an argument around that, but it's interesting because putting private credit in the ETF wrapper, that is the topic du jour right now, and I think that'll be one of the key storylines we see heading into 2025. With bank loans specifically, I don't have strong views here. I'll just say that if you look at credit spreads right now, they are near historic lows. And so from my perspective, I'm just not sure this is the right spot to be loading up on credit, especially riskier credit. Though I will say with bank loans, as you were touching on, you do have that floating rate component. And so that can be helpful if rates rise. I think there is some uncertainty moving forward around what rates will do. So that does offer some protection. I'm just not a huge fan of loading up on credit right now.
Yeah, everybody wants to own fixed income to a certain extent, short term, everything from a year or less, money market funds, all the way up into sort of the middle of the range, 5 to 7 years. There's a whole bunch of laddered bond ETFs out there. You've got the bullet ETFs. Tell us a little bit about what they do. I mean, essentially here, folks, you don't know these are, they have defined maturity dates, and you can buy them in many different flavors. You can get corporate, high yield, and so there's one, BSCQ there, that ends in 2026. What do you get when you get here, and what's laddering,
Sure.
and how is it helpful?
Yeah, so the bullet share suite, BSC for corporate, BSJ for high yield, and BSM as the prefix for munis, all have a target date. So they're really pinpointed towards a maturity, which allows investors either to target their duration across all three of those asset classes, allows them to do some level of liability matching, right, in terms of funding needs or other opportunities they need within their portfolios. But it's really the specific pinpoint accuracy that we see investors using it for. But it's not just duration management, right? Fixed income this year has grown far beyond its market cap. So fixed income utilization via ETFs has really started to grow. And we've seen that not just within the bullet shares suite, but within active fixed income and across the board.
Quickly, for people who don't know about laddering, you could buy a 2026, a 2027, you could buy a 10-year or a 5-year treasury or whatever, the same one. You could buy a 5-year treasury and have it expire in 2027, 28. Right. This is laddering, right?
Right, yeah, so what's old is new again, right? So what better way to manage duration but simple ladders to stagger out some of your duration management. These tools do exactly that for you, and we're seeing that adoption rate increase.
All right. Nate, fixed income is a bit of a problem though right now. I mean, there's a lot of uncertainty over the future direction of rates. I know our viewers love 4% anything, and they're quite happy with their 4% money market funds or even 5 years treasuries. But your view here on what's going to happen in 2025?
Yeah, I do think fixed income is a huge challenge for investors and advisors right now. And if you think back a few months ago, the prevailing thought was that rates would be coming back in. But now, as I was alluding to previously, there's a lot more uncertainty. And there's some thought that the Trump administration could reignite inflationary pressure. There's also concern over the budget deficit. And so I think anytime there's rate uncertainty, it makes it a challenge. And that's why something like the bullet shares, they make a ton of sense to me, because these do have defined maturities. You can ladder them out. That can help manage that rate risk. And I think investors like that control and flexibility. But fixed income, it remains a huge challenge.
Yeah, I maintain that anybody who knows exactly what's going to happen in interest rates isn't paying enough attention, because it really is rather uncertain right now. Fascinating discussion, folks, as we do every week, the best people in the business here on ETF Edge. And that does it for this week's ETF Edge. My thanks to Brian and Nate. We've asked Nate to stick around and provide us some perspective on other 2025 trends coming up on our ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.